Retiring early isn't risky. Retiring early without a health insurance plan is. If you're leaving employer coverage and you're under 65, you could potentially face premiums in excess of $1,000 a month. However, retiring early does not have to drain your savings. With some careful planning within the rules that exist within the ACA, you can find potentially affordable coverage. You can retire early where you may have thought you could not. So let's get into some of these options that are available to folks that are trying to bridge the gap from retirement to Medicare eligibility. So let's kind of get into what some of the options and strategies are when you do retire and you're not yet eligible for Medicare. So the first off, you have COBRA. So COBRA is a continuation of your employer coverage. Depending on what your COBRA eligibility right was, you could end up being able to extend COBRA for 18 to 36 months. Okay. Now, typically when you're on an employer sponsored plan, the employer is paying about on average 70 to 80% of the premium, which is pretty significant. So with COBRA, you're paying 100%, 102% of the premium of what the full premium was, because the 100%, then they tack on a 2% admin fee, essentially is what you're paying for the third party to administer the COBRA plan. Now, sometimes COBRA, it's not like, sometimes people say, oh, well, COBRA is too expensive, but they don't even know what the cost is, right? They're just going off things that other people have said. So depending on the population of the workforce, the folks that make up that employer plan, sometimes it's not that expensive. If you're in that 63 and a half to 64, and if you make over the amount that would make somebody eligible for the advanced premium tax credit or subsidy, and COBRA's let's 600 to 800 a month, that's not that bad, right? Especially if you were on maybe a high deductible HSA eligible employer plan, that may be not a bad option to continue. Now, on the flip side, you could have been in a group that had a lower deductible, maybe an older population, and the premiums are excessive, maybe exceeding 1,000 up to 1,500 a month. So obviously, if that's the case, you may want to look elsewhere, right? So another option would be ACA coverage. Now, we'll get into this in a little bit later, but with some planning, you may be able to take advantage of some of these tax credits based on how you utilize savings for income, how you may delay income, or by contributing to qualified plans to reduce your taxable income, right? So ACA coverage overall as an option, this works well if you're an individual who projects your coming year's tax return to be under $62,600, or if you file jointly with a spouse and your income is projected to be under $84,600, because you will likely qualify for a subsidy, which will offset a lot of the costs of the plan. It's going to make it very likely it's going to be less than COBRA, right? You may be looking at anywhere from, if let's say your income's $50,000, you may be looking at anywhere from $200 to $600 a month, depending on the plan that you choose. Now, you can somewhat control your income, like I just mentioned, based on what you're using, right? So this income number, they're going off modified adjusted gross income. So the adjusted gross income, that's that line 11 on your 1040. And then the modified part is they add back in certain forms of non-taxable income, like Social Security income or foreign earned income. But again, if you're not taking Social Security, you don't have that foreign earned income, you don't have to worry about that piece of it. And then essentially it's your AGI. So sometimes when people retire, they're kind of dependent on withdrawals or distributions from qualified plans, which is taxable, which counts towards your adjusted gross income. So you can delay those distributions if you have other income, right? So you could use savings for your income for this year or 2 years or 3 years. Or you could take out a loan. It could be a margin loan against assets that you have in an account, or could be a loan against a cash value life insurance policy. Those, again, are not taxable. So there's a lot of different ways that you can kind of plan ahead if you have those alternate passive income, non-taxable vehicles in place, right? Other things you could do to reduce your taxable income, right? You can make a IRA contribution. You could make a contribution into a health savings account. So if you're over 55 and you're married, you can contribute an extra $1,000 a year based on those HSA catch-up contribution limits. So HSA contributions, it can be pretty substantial. I mean, you're looking at $97.50 for a couple that's over 55, $87.50 for a couple that's under that, right? And then if you're a single person, that catch-up contribution limit is $500, right? So the other thing to note too, if you do have a health savings account, let's say you've been funding it for years, you can pay COBRA premiums out of an HSA. You can't pay individual plan premiums out of an HSA, but if COBRA, if it's not that big of a difference, people may elect to use those funds to pay those premiums because that's not something you can normally do. It's good to build up an HSA too over time, because then you could take out the funds after the age of 65 with, it doesn't have to be used for medical expenses. It's not taxable unless it's over basis. If you're using it for non-medical expenses, it's not taxable at all if you're using it for medical expenses. So it's a great vehicle to reduce your taxable threshold, to plan for the future as well, right? Another option, you can go on to your spouse's coverage. Obviously, this is not always an option, but if your spouse is working and you retire, that is a qualified event that would make you eligible to enroll in her plan if that makes financial sense. Okay. The fourth option, and a lot less common, is employer retiree benefits. This was way more common in the past, like 40, 50 years ago, not so much anymore. The statistic is 21% of all large employers offer retiree benefits. An example would be the HOP program through PEASERS, which is for teachers, people that work for school districts, right? Those retiree programs, they may make sense if that's available. Right. And then we did talk about, using the HSA funds to pay COBRA premiums, contributing HSAs to reduce your taxable income. One big change in 2026 was now all bronze plans on the marketplace are HSA eligible, where in the past you had to have an HSA eligible plan to contribute to an HSA, and those HSA eligible plans had strict definitions around high deductibles, whereas other bronze plans now in 2026, you can go to the doctor, just pay a copay, maybe it's $20, maybe it's $50. Those plans are now HSA eligible, where in the past, you would be paying towards the deductible for all covered services except preventative on HSA eligible plans. So again, the HSA is a great vehicle, something to consider. Another option is what they call the barista fire approach. So the barista approach is, you get a part-time work, which offers benefits. So usually you have to work 20 to 30 hours to be eligible. Like some common examples are, Starbucks. That's where this barista fire approach term comes from. But there's other large companies that kind of do the same thing. Home Depot, Costco, UPS. Those are some other companies that offer those benefits for part-time employees. Another big one, health sharing plans. So health sharing plans is important to note. They're not insurance, right? You contribute what they call monthly share amount. When you have a medical bill, right? Those medical bills are submitted to the pool, the sharing pool, for reimbursement. These plans are typically 30 to 50% cheaper than ACA plans. Typically, they're for folks that are healthier, maybe don't have pre-existing conditions. You just want to be careful with that. Just, knowing what's covered, what's not covered. They may have certain limitations. Some of the plans have different lifestyle requirements. You have to attest to a certain faith, potentially, on some of them. Typically, you can't be a smoker. So there's different lifestyle requirements, but There's 1.5 million people enrolled in those plans, and they are significantly less than ACA plans if you're not qualifying for a subsidy. So that could be an option. Another option is short-term insurance. Now, some of the recent regulatory changes have kind of dampened this strategy because in a lot of states, you can only have the plan for 3 months at a time. And, you may not be able to continue it past that, right? So there's some states that have what they call, 3 by 3 by 3. So 4 3-month terms strung together that can get you a year. And those plans are typically, they're less than non-subsidized ACA plans typically. They're geared more towards like the catastrophic. Typically you might see they'll have a coverage limit of $1 million, $2 million, 500,000, depending on the carrier. So those are things to look at as well. The biggest thing is really planning, right? And your timeline. So if you let's say you in 5 years, you're Medicare eligible, but you want to retire next year, you can make the necessary planning steps to make sure that the income that you're using is not taxable income. You could delay distributions. You could take out a larger distribution, let's say in December 31st of a year, and you're starting coverage in January 1st. Well, the AGI, or the modified adjusted gross income that they're using for ACA eligibility, is for that coming year, right? So like, let's say somebody started a plan on January 1st of 2026, they're using what you project your 2026 income to be when you file your tax return in 2027 for the 2026 tax year. So any distributions you would have taken out in December of 2025 would not count towards that modified adjusted gross income. So with some careful planning, you can kind of control what your income is going to be as well. So that's important to note. If you're a couple, you're saving $10,000, $5,000 for an individual by qualifying for a subsidy. It can definitely be a good option. Okay, so just to recap, lower income, you're typically looking at a ACA subsidized plan. A higher income, you may be looking at COBRA. It might be cheaper than unsubsidized ACA coverage in some areas. Maybe you're looking at health sharing plans or spouse's employer coverage. Again, that depends on your health as well. So if you are higher income, you have some health concerns as far as not necessarily whether you can get the coverage or not, because you can always get ACA coverage no matter what your health is. The premium is not based on your health. It's just standardized based on age, tobacco use. But, that's a consideration to look at when you're choosing a plan, right? COBRA, again, may be an option, right? So you want to be able to kind of see what's available for you. You want to try and get a good picture of what you think your income is going to be. That is a huge part of this, and kind of implementing some strategies to help you lower that, especially if you're right around that cutoff. Like if you're a single person, you're around $62,600. You're like, oh, I'm going to make $65,000. Well, you have some options then. You can put money into an HSA. You can put money into a qualified plan to reduce your taxable income. That's a strategy that a lot of folks implement. And to learn more about how the ACA subsidies work, how the reconciliation process works, the changes that have taken place here with some of the recent legislation, you can check out this video as well here, and you continue to follow us, and we'll keep you in the loop with updated relevant industry content.